Good evening, everybody. Welcome to Learn with Stanley webinar number 37. Thank you so much for joining me today, this evening. I hope you guys had already had your dinner and you guys are ready for an exciting 1 hour webinar where I'm gonna talk to you guys about two very new stock that I have recently been researching on, and some of the ideas that I might want to share with you guys. And also, I would love to hear from you what you guys think as I walk through my analysis as well. So if you are ready, why don't you click on the chat box. Tell me where you logging in from and welcome. And if this is your first time joining me, do let me know. Or if it's the number 37 time you're joining me, also let me know. Thank you so much. And let me pull up my PowerPoint. All right, here we go. So welcome again. Today, webinar number 37. Let's look into two very, very boring ideas for you guys. And as always, just a short disclaimer. I do work for iFast Global Markets as a wealth advisor, but everything that you see here is coming from my own research and not from the company. So these are all my personal view and research. So please do not constitute this as investment advice or recommendation or views from my company, right? And this will just be for your education purposes and also just on a sharing basis. Welcome to Learn with Stanley, and this is part of our webinar series where every 2 weeks I'll bring you analysis on some of the stocks or ETF or funds that I have been researching on, or sometimes looking into investment philosophy, investment strategy, and also maybe sometimes we talk a little bit about personal finance as well. And thank you so much. And if you have not, if this is the first time that you're joining me, I hope that you would go down to learnwithstanley.com and then join our private mailing list so that you can get all the updates on the future. If this is the first time that you have joined my webinar, just a little bit about myself. I myself is Stanley, and I have mostly worked as a researcher for most of my finance life. And over the past close to a decade, I guess, I have mostly been sharing my view online and written many, many articles about that. And before I left my last job to kind of start Value Invest Asia by myself and two of my friends, we have written a book called Value Investing in Asia as well. And if you have not read it, I hope that you would find it in one of your local bookstores or in Amazon and check the book out. Apart from that, right now I'm working with iFast Global Markets in Malaysia, and iFast is basically a wealth management platform that allows you to plan your finances and your investment throughout all the major asset classes that you can think of. And we have access to everything from stocks to funds to bonds, also our in-house managed portfolio as well. And even just for cash management as well throughout all our money market funds. I myself work as an advisor, so I help clients look into how to repurpose their portfolio, how to rebalance their portfolio, or just create a program for them to build and invest for their future financial goals. And if you have been following me for some times, you realize that my investing strategy and philosophy might be a little bit different from mainstream. And I focus a lot on spotting very, very long-term growth opportunity in the market and try to manage risk in terms of the selection that we go into. In that way, we don't. I myself don't try to trade too much in the market. There are some positions that I have held for more than a decade, and I'm still holding it on to them. And this is kind of the strategy I tend to adhere to, and also try to introduce them to my clients as well. That it's okay that to not react to all the news that's happening in the financial market. And what we are trying to do is create a system that can allow us to invest and save uh, in the long term. Even as our wealth and portfolio grows, our strategy can stay the same, building what I call my everlasting portfolio. And that's has been my main strategy for the past 16, 17 years. And this is just my own personal record that I have been tracking for the last 16 years and 17 years, and how I can already see very tangible results from it, which is why I'm hoping that I can introduce this mindset and strategy to some of my clients as well. So if you might be interested to have a chat with me one on one, you can always reach out to me. You can either scan the QR code here to fill up a Google form, and I'll reach out to you, or you can actually just go down to learnwithstanley.com, and if you scroll down to almost the bottom, you'll see that there is a form that you can click on to let me know your particulars, and I'll try to reach out to you uh, when I finish up, when I get to some of my other uh, backlog clients that are waiting to speak to me. All right, so that's all, and let's get started on the webinar for today, which is two very, very boring stock ideas for you to review. And there's two ideas. They're in very, very different industry, but more or less having a very, very similar kind of what I call a hidden gem, a boring hidden gem kind of stocks. And I'll go through one on one with you. Number one is a company made famous by Andy Warhol, because in that very, very famous painting that he make, he mentioned that he draw it because it's the same lunch that he has ate for the past 20 years, and it's a reminder for himself, and that he wanted to highlight that piece to the world. The second idea is uh, a company that has been a backbone of America, a company that has built America for um, close to, I think, more than 100 years now. And this company is at the threat of being disrupted by a company called Tesla. We're going to look into it. Is the fear by most investor warranted? And what could the company be doing? And is this company really as is it really facing this huge disruption inevitably? Okay, then we'll finish off with a summary on how do you go about looking for such hidden gems, and we'll end off with our usual spin-off segment as well. So this is the painting that I'm talking about by Andy Warhol, and he painted it in 1962, which make famous the Campbell soup. And the company today is Campbell Soup Company. The Campbell Soup Company is a very, very interesting company, and it has actually been, let me see if I have the flow here. It has actually been founded in 1869, 1869 in New Jersey, and by Joseph Campbell and Abraham Anderson. So it actually started out as a company that sells canned tomato, vegetables, soup, condiments, everything. But it's the actual product that's put in the can, and that's how they started. Um, Uh, and then in 1897, a Dr. John Dorrance joined the company, and he is the one that revolutionized the company today. And Campbell Soup today actually kind of holds more like close to a monopoly in ready-mix soup market in the US. It still owns about 60% in the ready-mix soup market in the US. And the soup business makes up about close to a third of the current business right now. And so it is what it's most famous for and one of the key business that it has. And if you can see, this stock has been doing pretty well over the very, very long term. It is tracks back all the way to 1985, and that stock has gone up close to 550%. And today, you can see that the stock price has been declining and it's actually trading at a very, very interesting valuation. From my own estimation, around a 10 times PE and a forecast PE that I could have added to it. And this company, maybe before that, okay, this company in 1897, when Dr. John Torrance joined the company as their chemist, he is the one that invented this condensed soup in a can. Um, and he came in to the business because his uncle at the time was actually already promoted to become the president of the company. So he was brought in and then as a chemist, and he invented this new form, and this is the main product that they try to promote once it is discovered. And in the early 1900s, 1930s, where advertising started to become more famous. That's where Campbell Soup really jumped into the advertising bandwagon, uh, and started making this company uh, more well known in the American consumer mind. But this company has, when you look through its history, there is also um periods where they have faced a lot of issue in the stock market and against, um, sorry, against some of the not so. Hey, give me a minute. They have faced some of the not so glamorous outlook by the stock market, especially one of the key period is in 1999, together with a famous investor called Warren Buffett. And this is a famous article by Forbes saying that Mr. Buffett has lost his touch, right? In the dot-com boom, he has lost his touch. And his method of investing is too old school for the new dot-com era, right? And everything is very, very focused on technology at the time. But as we know it, we know that that strategy has not really has continued to do very well. And company like Campbell Soup continue to do well even after the dot-com bubble. Why I'm bringing up this is because Campbell Soup come into my radar that it might be an interesting stock to look at because I was looking also at the US technological sector and the exuberant that investors has put into this sector over the past few years, especially since COVID, where there is up and down, but generally, people has becoming more and more optimistic about technology and about AI, right? I can tell you that this webinar is AI powered. I put everything into ChatGPT to have it edit for me, and make sure that the flow is okay. But so this webinar is also AI powered. But you can see the US technology ETF in this case over the past 5 years that has been growing roughly about 20% CAGR, so 20% on average every single year. It's a fantastic return for a passive uh, ETF, but it also kind of seems almost unsustainable for an industry to continue to grow at such a high pace when the US economy is, relatively not growing that much. And when we look at the database that I have it here, that technology ETF space right now takes up uh, about 700 billion asset under management. And the next biggest industry is actually the financials, just shy of 100 million, 100 billion asset under management. So that is, a 7 or 8 times uh, smaller size compared to the number one and number two sector. That is actually quite drastic. And I think I have roughly add up, from 2 to 11. I think if you add up all of them together, their asset under management is still not as big as technology as one sector. And it really shows that so many of the funds are going into the technology sector. And today, if you know anyone that is investing, uh, a random guess is that they have some position in technological stocks, and all the money is going into the technology sector. Of course, I'm not saying that the crash for technological sector is imminent, but I'm just saying that there is a lot of interest in this sector, and we should be thinking of how we can diversify away this risk, and which is why it brought back my interest into some of the boring companies that we'll be sharing today. And so that's the backstory of why I started to look into these two companies. Um, but again, I'm not saying that we will be facing uh, a crash in the technological sector. I myself is also invested in the technological sector in the US market, and predominantly, I think if I run through most of my investment, I would say that because the market is so dominated by technology, my own portfolio would also very very skewed to technology. But as the risks increase more and more towards this sector, I think it's only prudent for us to start to think about diversification away from this sector to make sure that our portfolio is still resilient, irrespective of how the market would perform in the next few years. And which is why Campbell Soup is one of that company which I talk about. It has been around for more than 100 years now. And this is Dr. John Dorrance that invented this condensed soup formula that is put into the can. And the founder of Campbell Soup, they actually relinquished control of the business and sold it to the Dorrance family in 1914 or 1915, around that period. And Dr. Dorrance became the president of the company and ran it till his death in 1930. And the company actually IPO'd in 1954, 1954. And I can't find data going back so far away, but this is the data that is coming from 1984, where the stock price is around $1.43. Today is roughly about $32, $33 per share at the moment, even after a huge decline in the past few months. This is one of the interesting era of Campbell Soup, where they came under attack in 2018 by an activist fund manager in Third Point called Dan Loop. And Dan Loop actually created this video to share it with CNBC to criticize the Campbell Soup management and how he wanted to change the management. Let me see if I can play it, maybe just play it like a 10-second clip for you guys. Uh, I'm not sure if you guys can hear it. Let me share again so that you can hear the sound.
Left behind by failed leaders. What an incredible waste. One of America's most iconic brands being left behind by failed leaders who punished shareholders' loyalty. $1 invested 20 years ago in the S&P 500 would be worth $4.06 today. $1 invested in the S&P 500 Consumer Staples Index would be worth $4.37 today. But $1 invested 20 years ago in Campbell would only be worth $1.19.
Yep, I'll stop it there. But basically what he's saying is Campbell Soup has been mismanaged and hasn't been growing at all. And he, at the time, he recommend to change the entire board of Campbell Soup and change the CEO to make it more growth driven and change the management. They had a lawsuit, but they came to an agreement where the board allowed him to bring in two board members that he chose into the board, and then they searched for a new CEO. I think that was where they just settled the issue, and then look, was satisfied with it. I'm quite sure maybe they have already exited that position, but you can see that even when they have been not growing that well for a long period of time, activist investor is still very hard to change the management of Campbell Soup, mainly because the Dorrance family today still hold about 40% shares of the company. So they still have a very, very huge influence over the company, which is why it's not so easy for activists to start to make anything too drastic on the company. But I wanted to share with you guys also some of the information about this company. Although it is not a fast-growing company, you can see that its revenue hasn't really moved that much. Its gross profit hasn't really moved that much. But it is a company that is generating very, very good return on equity. So they're generating good profit. They are generating very, very good free cash flow, which most of it they dividend out, and which is what makes the company very attractive, right? Which is why the company, although hasn't been growing very well, but is still a company that many investors like it, because this is one of the very few companies that has been paying dividend for more than 50, 60 years. And today, the dividend rate is about 4.7%. Even for foreign investors like ourselves, after tax, we still get back about 3.3% after tax, which is still a very, very decent dividend from this company. And Campbell Soup, over the past few decades, they have also transformed, of course, to not just being a soup company, but rather moving more and more towards other brands as well. They have a snacks division and other food products as well. So today, soups only make up about close to about 30% of their total sales, while snacks is about 50% of their total sales. And the company has really been improving on their supply chain and their manufacturing network through digitalization as well, so to improve their margin over the years. So this has been one of the key ways that the company is eking out more and more free cash flow from the business, even though it's not seeing very, very fast growth in the business. Apart from that, Campbell, of course, is also a serial acquirer. Like many of the brands here, it's being acquired by Campbell over time. Um, their most recent acquisition is a company called Sovos brand, which make a lot of pasta sauce uh, for the company. So that will be, uh, I think, a key way on how they are planning to grow it in the future as well. So improving and buying other brands into their portfolio to becoming the next, like a Nestle and a Kraft Heinz. So when we compare it, some of their valuation to their peers, Campbell, the PE you can see here is like 21, but that's because they have some impairment in the last financial year, which is why their E was slightly depressed, which result in a slightly higher PE. But I would say that if we adjust for it, is maybe around 15, 16. But on a forward basis, especially when I look at the financials, uh, when I when I see that if they are able to pare down some of the debt, reduce on the interest costs, and also improve on their efficiency and their margins, this PE at today's price, it could be around 10 or 11 times at the moment, which is uh, pretty attractive, I would say. Even if you look at the yields, the dividend yield or their price to sales, you can see that they are indeed one of the lower ones compared to, say, Nestle uh, and Kraft. Okay, but this is what I have found about Campbell. And I have not invested in this company myself. So every time I share a stock on my webinar, I can assure you I would not buy it first and then present it to you, right? Straight away. It could be a stock that I have bought like maybe last year, and I want to share it with you. But I would not be buying it last week and then sharing it with you. Even if I buy it, it would most likely be after the webinar. But for this stock, I have a question for you guys as well, which is I'm still contemplating. I'm still contemplating because I'm thinking, yes, it seems like an interesting company, although it's not a fast growing company. It can be a dividend selection. But if we compare it with, say, the consumer staples ETF, ticker XLP, which buy some of the best consumer staple companies in the US. Now, which one would you choose? If I have, say, now I have a $10,000 right here, and I'm choosing besides Campbell Soup Company or just buying the ETF consumer staples select spiders ETF XLP. It's I'm still contemplating. So why don't you join in this contemplation? Put on your chat. Let me know if you choose the Campbell soup. Let me write it down. Or you choose the ETF, right? I love to hear your thoughts on that, how you might want to think of. So as you also join in to help me think, Let's go on to idea number two. And idea number two is also a pretty boring company, called Pekka Inc. And it's not a company that might be very familiar for us, but it is one of the biggest uh, semi truck brands, or not semi truck company in the US. And this is the company that has been around for many, many years and has been a pretty impressive boring compounder. So, in the last 40 years, the stock price has grew at about 11% a year. But it is also a dividend payer. So this company has been paying dividend for 86 years non-stop. And because it has been 86 years profitable non-stop for a truck manufacturing company. And today the yield is about 1.44%. So if you add back the dividend yield for this company, it could very, very well that as an investor for this stock for the past 40 years, you could be, getting like a 13, 14% compounder on this stock, which is very, very impressive. So Pekka has a long history. It's actually founded in Seattle in 1905. The name was Seattle Manufacturing Company, and they basically built train cars. So a sample here in the picture, and they built train cars because there is a timber boom in the U.S. and the loggers need to move the timber out of the forest using train, and they found an opportunity to by this person called William Piggott, found an opportunity to build train cars to fit into this uh, timber boom. As they, it's a gold rush, so there's many many company doing it. By 1917, the company merged with another company in Portland, and together they formed Pacific Car and Foundry Company. From then, it was continued to grow, but by 1924, around the Great Depression era, William Pickett actually sold the company. It sold to a conglomerate called American Car, and he left the business. But very, very interestingly, in 1934, a decade later, his son, Paul Pickett, actually came back and bought the company back from the original buyer. So he bought it back, and then he started managing it through a phase of very aggressive expansion. First, of course, still in the train car business. So until then, they have not been doing any trucks business. And then World War II came, 1939, and Pekka became one of the largest manufacturer of tanks for the US. So the Sherman tanks, as the picture here, one of the most staple tank in the US military at the time, was built by Pekka. So they were actually booming during the World War II period. And then again, in 1945, when the war is over, their entire market stopped and they got no more business and no more market. That was when they decided to bought over a company called Kenworth Motor Trucks in 1945. So they bought the company over and started building trucks. And that's when they became a truck company. In 1945 with Kenworth, still one of the biggest main truck brands in the US. And then they bought in 1958 PW Motors, also another big truck company in the US. And in the next few decades, they expand the supply chain, expand their market to different overseas market even all the way that opening in Australia, and then they started buying a lot of truck company in the in Europe as well. First in 1980s, called Fondant Trucks, and then with their one of their largest purchase, DAF Trucks in the Netherlands, and then again in 1998, Leyland Trucks in UK. So that's how they have been focusing on the truck business and then building it and expanding their entire supply chain. So now they build the trucks, they provide the leasing, finance leasing for the trucks, they provide parts and services for the trucks as well. Um, throughout mainly now still US and of course US when we say US and Canada, Mexico, and also in Europe would be some of their key markets right now. This company, as I mentioned just now, has been profitable since 1940. They have very, very prudent management, right? Even today, they have like $10 billion of cash in hand, and very, very low debt. And most of the debt, if not all of the debt, is actually being used for their financing business, right? Because they have to finance and for some of their trucks, then they will take on debt and then use that debt to finance out for the buyers of the trucks as well. And they have, from my understanding, the way they manage their finance company is very, very prudent. Their non-performing loan is less, like around 1%, which is very, very low, even lower for than most banks. So very, very prudent management that wants to see the company being profitable and paying a dividend and having free cash flow. So in the past 10 years, their revenue actually grew pretty good, about 5.9% a year. Net profit grew even better, close to about 12. EPS as well, earning per share also grew about 12%. Their return on equity over the past 10 years range about from 13% to 32%, different depending on year. So very good return on equity range for a company that has very low leverage, right? So a company with higher and higher debt, when it's profitable, they can inflate that return on equity number. And return on equity is basically saying that if the company has X amount of money today, say 100 million, how many percent can they generate in profit again for the next year from this base of value that they already have? And mathematically, if you have more and more debt to pile on to your existing capital, you will be able to generate more and more profit during good years. But we know debt is also a double-edged sword. When it's not managed properly, it could destroy the business. So without even touching into high debt area, this company is able to generate a 13 to 30% return on equity for a manufacturing business, which is fantastic. And of course, most importantly, the company has been free cash flow positive for most of its years as well. So here comes the problem. Why then is such a good company that's still growing, right? Unlike Campbell Soup, this is a company that's still growing pretty decently, not trade at a very, very high valuation, still at a very, very reasonable valuation. It's because of the challenge that we have seen in the automotive space over the past 2 decades, 3 decades, but especially in the last few years, the acceleration of the disruption of EVs. And although the commercial vehicles now is relatively untouched by this challenger and this disruptor, but we have seen the Tesla semi-truck give some demo before, and Elon Musk has given some very, very optimistic claims about the truck. For example, from their website, you'll read that the truck can go have a range of 500 miles, and it could be recharged 70% in 30 minutes, and that could add up to fuel saving of up to $200,000 in 3 years, which would mean fantastic news, especially most of the trucker in the US are a freelance contractor. So to them, that is saving directly to their pocket. And it seems like an amazing product that could really disrupt the market. But the problem is not so soon. The truck itself, the semi truck itself, sort of we have seen the demo, but then not much news after that. And when I look into some of the key research about this, there's still a very, very big hurdle that still need to be solved before such a possibility could come online, right? For a Tesla semi truck to be viable, um, to disrupt the current trucking industry, especially in the US. Number one is this is not a car with a relatively small battery pack, but a truck with massive, massive battery load. And just to charge it, you are talking about not even the fast charger that we have for cars might not be fast enough to charge a semi truck. So you need even faster charging to take on. That means a lot of big load for the utility company. And my understanding that is that today, if they want to build such a charging station, the power utility might not even agree to it because they might not be able to handle the load, especially say in a trucker stop. If they need to, have 10 chargers all around, it's almost impossible that the infrastructure cannot, at the moment, cannot handle this kind of load. The only possible way is that they need the Tesla battery pack as well, right? You're talking about the industrial grade 20, 30, 20 footer battery pack to be there stationed so that they can handle some of the load. And that battery, that huge infrastructure battery, maybe can handle a charge of 2 trucks. So to really scale it up, there is a lot of infrastructure that need to be rebuilt to make it a reality. And all these costs is not even factored in when Elon Musk is talking about a saving of 200,000 a year for the trucker. As all this infrastructure is paid for, somebody would have to pay for their construction costs as well. And most likely it will come in the form of cost to the consumer, which is the trucker. And plus, there is no indication of how much of this Tesla semi truck is going to cost. And trucks, because they are commercial vehicles, at the end of the day, you need a product that makes economic sense. It cannot be just because it looks cool that the consumer will buy the product, right? For a passenger vehicle, maybe just being cool is enough. But for commercial vehicles, it still, at the end of the day, has to make economic sense. And combine all that with the reality that battery has a degradation over time, the economics for the trucker will only get worse the longer they use the truck. Whereas it might not be the case if they use a diesel truck, that they can still relatively maintain the maintenance cost of the truck even for a long period of time. So all this kinds of convince me at least that Packard would still have a long, long runway before they really need to face the issue with EVs in the market. And it should be a company that would continue to do pretty well uh, in this space, especially when they already have the network and the service network, the parts for all their products and across all the regions that is all well established with the infrastructure to support the truckers and the logistic companies and the industries. People would still prefer to work with a company like Pekka uh, instead. So that's my conclusion so far. And if you look at the valuation comparison from our iFast database as well, you can see that Pekka is also one of the few companies in the automotive space that is trading at a pretty low valuation. So you can see it's at 13, whereas other commercial vehicles company like Caterpillar or Deere are trading at 17 times or 24 times. You can see that Pekka actually trades more closely to car companies like Volvo or Toyota. Maybe not Toyota, but like Volvo and other automotive companies that is already being disrupted by the EV competitors. But I would feel that Pekka, we should actually compare it closer to um, equipment provider like Caterpillar and Deere, and that would be the main kind of real competitor that they they should be compared with. And from that note, they look to be at a pretty decent valuation. And then again, before I finish up, there is also a choice for Pekka, right? So you can either think of whether to invest in Pekka or should we look into the ETF space again that allows us to invest in the entire US transportation industry. Of course, this would include other companies like even airlines, logistic companies, all that would be included inside this ETF compared to a specific company like Pekka on the trucking industry. How would you make that choice? I hope that you would let me know your thoughts. I would love to hear them. Just pull up on the chat box and have a discussion on that. But that's the two companies that I wanted to highlight to you guys, and I hope that you enjoy it. But just as a summary, I also want to share with you how can you go about finding your hidden boring gems in the future as well. And I think these are some of the prerequisite that you can look into to get started, right? Kind of see it as a screen that when you see across this kind of characteristic in a company, they could be potential hidden gems with boring business for you. So look into areas where their business has already matured, so not in the hottest industry that is available now, right? So definitely not in the AI space or the GPU space to look at them, but more for the matured business with slow or maybe no growth. They typically has a pretty low valuation, so search around for lower valuation companies. Um, and in this case, when you search around for lower valuation companies, do bear in mind that there are a lot of very, very bad companies that are trading at very, very low valuation. So you need to be a little bit more aware and not be tempted to touch some of that. So you have to combine all these characteristics into one uh, to consider them as a possible hidden gem potential, right? And not just go for any company with a low valuation, right? So that's just one of the prerequisite. A company should be already generating good free cash flow, right? If they can generate it with very, very minimal debt, that is even better. So the company with very strong financials and producing good free cash flow. Another plus point is it if it is a company that has a very strong history of continuously paying dividends, if it is able to continue to pay dividends for a long time, meaning that they can sustain that free cash flow, and they can still grow and sustain their business. That is one of the key factors I would say that we can feel more assured that this company has the longevity, and also could be the hidden gem that you are looking for. So, next segment is my spin off segment. This will be something completely different from our topic of the day. And I just wanted to highlight to you guys one of the latest podcasts that I listened to. This episode is called A Godfather of AI. And it's part of the Diary of the CEO by Stephen Bartlett, one of my favorite podcasts to always listen to when I'm driving. And basically, he interviewed this professor. Can you call him professor? Yeah, Professor Jeffrey. And he explained a little bit and talked a lot about the danger of AI. And actually, during his early times of when was developing AI, what are some of the decisions that they make? What are some of the trends that surfaces? But he really touched on a lot on his fear of what AI could become, and how little attention that most of the AI leaders in today's world is not really thinking about AI safety. So interesting talk, and I think this would be a valuable listen for you guys, especially for those of us with kids. It will be interesting to listen to understand a little bit more about how the world will like for our children. All right, and I hope you enjoy the session. But just as a reminder again, I'm Stanley, and I work for IFAS Global Markets. I am actually attached to the Johor Bahru branch. So if you're ever in town, you can hit me up. I love to have a one-on-one chat with you. But if not, you can also check us out if you want to find out more about IFAS on how it can help you to build and manage your wealth together with my help. I hope you reach out to me and let me know. And some of the key things that I try to do differently is I really focus a lot on your personal financial objective rather than having a one size fit all strategy for everyone. My I would say my first three or four session talking with a client, I would not be looking into suggesting any things that for them to buy or suggesting any product for them. I would really just be there to understand what is their current situation and understanding what is their financial objective for the long term, and then come up with a plan and a program that will best suit them to help them truly build wealth for the long term. And when it comes to investing, I also try not to be someone that would constantly ask them to uh, change strategy and move around and chasing after the hottest trend out there, but rather how can we design a portfolio that is diversified and has be able to maintain the risk uh, for the so that the client is able to accept it, right? Some of the tools I use would be like a software that I will actually simulate out, what are actual objectives that they might have, what are some of the key risks if they face, what will happen and how they should plan for it. With the help of software, I'm able to show them scenarios that they wanted to look into. So if that is something an interesting discussion that you want to have with me, feel free to fill up this digital form either from this QR code or from my website learnwithstanley.com. Just scroll down to the bottom, you'll be able to fill up the digital form. Or if you just want to reach out on WhatsApp, that's fine as well. That is the website. And when you scroll to the bottom, you'll be able to see this free financial health check link. And that is the form to reach out to me. Just sharing some of the portfolio that I might suggest and build for my clients would look something similar to this, where I focus on building ETF portfolio. Oops, building ETF portfolios to help clients have a peace of mind through ETF to diversify the risk and still make sure that it's the best cost effective mode of investment for them. So thank you very much. I hope you can join me again for my next webinar, or you can follow me on LinkedIn or Facebook or YouTube. I love to keep in touch. These are my accounts. You can find them all in learnwithstanley.com. And as always, before we go, I always end with a quote that I found throughout the week, sort of a reminder for myself as well. And this one is by a famous philosopher called Winnie the Pooh. And he said, Rivers knows this. There is no hurry. We shall get there someday. So, regardless of what dreams and aspiration or goals that you might have, don't rush it. It's okay. You will get there one day. Enjoy the ride. So, with that, thank you very much. My name is Stanley. Till we meet again, invest safely, guys.